Hello, everybody. This is Brian Lysing with Financial Brokerage from our Life Department, and you have joined the Life Insurance Quoting Beyond the Price webinar today, and I want to thank you for taking your time to do so. I sure appreciate that and all your support with business over the years here at Financial Brokerage. For those of you who may not be familiar with Financial Brokerage, we are a national life insurance marketing organization working with, of course, life insurance, but also annuities, Medicare supplements, disability insurance, long-term care insurance, critical illness insurance, with agents, producers, registered reps, all across the country. And we've been at this for around 25 years at this point in time. I've been here for just over 20 myself. Spent some time, like you, out in the field selling everything from renter's insurance, auto insurance, to life insurance, and even getting into variable annuities and mutual funds and everything in between. Today's webinar is part of a series that I'm calling Life Insurance Basic Training. The whole series, 6 parts, are designed to help you become more comfortable bringing up life insurance in conversation with clients that you have for other product lines. I realize many of you do not specialize in life insurance. You make the bulk of your income off of another product line. However, life insurance presents a tremendous cross-selling opportunity to more closely tie those clients into you and your office rather than going somewhere else. Again, the point is to help you become more comfortable bringing it up, but also quoting and presenting and ultimately selling life insurance to those clients. If you caught last week's webinar, that was the first in the session, and we reviewed our quoting engine, the primary term in GUL quoting engine on our website, basically how to use it, what things to watch out for, and how to make it work effectively for you once you get in there. Today, we're going to go beyond the price and beyond just a basic comparison. Of course, we'll start with that comparison, but there are several things in that quoting engine, some information that the quoting engine doesn't necessarily give you unless you know exactly what to look for. And we know not all clients purchase primarily off of price. There are other factors, other features of the products that would incentivize them to purchase something that costs a little bit more. Unless you know what that is, though, you're never going to have that conversation with the client, and you're never going to give them that extra feature and, of course, collect that extra commission from the slightly higher premium involved. There are 5 items that I've identified, and we'll review those, but so you know what's coming, we're going to review companies that don't require a impairment exam, companies that add in critical and chronic illness riders, one company that gives your client a very unique coverage continuation option, a company that could potentially allow your clients to decrease their term premiums over time. We'll also touch on conversions, where to find the information so you know who has better options for converting. And then at the end, I'm going to cover what I'm calling a bonus idea, how to hack the system for your clients that are around age 70. If you're running a term quote for people at that age, there's actually a lower price out there in many cases, and we'll get to that at the very end. All of your lines are muted to cut down on background noise. You do still have the option to ask questions and post comments. You can do that in the control panel that you see on your screen, and I'll get to as many of those as possible at the conclusion of today's webinar. And bear with me just a couple seconds here. Okay, I think we're good. All right, so our main quoting engine, to get there, if you recall last week's webinar, you want to go to financial-brokerage.com, and if you click on quotes, you will get there. I've already done that and brought up a second tab. Again, this is our main quoting engine that you may have seen if you were on last week's webinar. I've already input some data for a 45-year-old male, 20-year term, $250,000. In this case, this person is a preferred non-tobacco user. And I'm running the numbers right now. If I recall on these webinars in the past, there is a little bit of a lag between what you see on the screen and what I'm able to see here, so I may be speaking a little bit ahead of what you're seeing on there. All right, so you should be seeing a listing of the quotes for this person. We've got Banner, Protective, AIG, all of the usual suspects over here, really. Now, you might want to send that to your client. You can click on the top few and create a comparison and send that to them. But look, we've got basically the same price among these companies. It might vary by just $1 or $2, or really just a few pennies a month. So how do they make a decision? Do you go with the lowest price one? Do you flip a coin between Banner or Protective, or do you bring something else up with them? Well, first item I want to tackle is no exam underwriting. Maybe this person doesn't want to go through the hassle of having a nurse stop by and having to provide fluids for a lab test. It's inconvenient, takes a little extra time, and with the pandemic still going on, nurses are in short supply. It might take a while for that to happen, right? So let's say this person is really interested in applying for a company that does not require an exam. Well, from working with this, I can tell you that most of these companies you see listed may or may not require an exam. They're going to do an initial electronic underwriting process and then determine if an exam is going to be needed for this person. So you could go that route. Or I also happen to know that this company right here, SBLI, this person's face amount and age, they will not require an exam. So how do I know that? Where can you find that information? We have that on another tab on our website. And here it is. If you hover over New Business and look at the drop-down menu, we have Underwriting at the bottom. And it's going to pop up another sub-menu, and you're going to see Accelerated Underwriting Guide. If you click on that, you'll have another tab. And here we have listed the companies that do not require paramed exams for clients, and it lists the ages where no exam is required. It lists the face amounts, and then what products. In some cases, this only applies to particular rate classes that we think the client would qualify for. In many cases, it might apply to an online electronic application, but not a paper app. This guide is going to tell you what's what and if your client qualifies. The quoting engine does not have a way to sort through that, so we've posted it out here. And this is updated fairly regularly as the companies change their parameters. Now, the first listing you're going to see here are the companies and the parameters where no exam is required if the client meets those conditions. I'd mentioned that there were a few companies that may or may not require an exam, depending on the initial electronic pre-screening. And you'll see that listed on page 2. And these are all the parameters for your clients where they may or may not require an exam. We'll just have to see, and really just have to start the process to see if they'll skate through without that. I can tell you that the numbers that the companies give us, as far as how many people, what percentage will qualify for no exam, it's generally about 40%. About 40% of all applicants nationally across all ages will not have to go through a paramed exam if they meet these criteria. If they do need an exam, they can still qualify for the very best rate classes. It just means that they tripped one of the triggers that the companies set up ahead of time that said, okay, we want to take a little bit closer look at this person just to make sure that they're as healthy as we think they are. So again, if you want to present a company that doesn't require an exam or might not require an exam, take a look at this chart. Again, under New Business and then under Underwriting, and you want to search for the Accelerated Underwriting Guide. That will be a deciding factor for some of your clients. Now, another feature I wanted to bring to your attention, the second feature, I mentioned earlier, some of these companies have critical or chronic illness riders built into their products. And unfortunately, this quoting engine doesn't tell you who has that built in. And I think we may have a guide for that out here. But if you have a pen handy, or if you have the note section of your smartphone ready to go, we have 5 life insurance companies that offer critical illness or chronic illness on their term policies. One of them happens to be North American, American National, Nationwide, Transamerica, although you have to be careful. It's not their Trendsetter Super. You're going to want to search for their Trendsetter LB. They tell us LB doesn't stand for living benefits, but I think I would disagree. And then we also have Emeritus with their FLX living benefits term. Those are probably the only two that have anything regarding living benefits in the name of the product. So there we've got 5 companies with living benefits, and you can see in this person's case, the lowest cost product would be $31. The lowest cost one with living benefits is $34 a month. In my opinion, it is well worth it to get something that allows you to accelerate at least part of the death benefit if you have a critical illness or a chronic illness. Now, if there's anybody in California or with clients in California listening, the same group of companies does not apply. Contact me for the specifics there because they will probably change. But there's not quite so many options, and they're slightly different in California. And eventually in your screen, you're going to see just these 5 companies showing up. If you want an easy way to remember who they are, take a screenshot of that with the 5 companies listed, and that way you'll know who has living benefits on their policies. Now, most companies have a terminal illness benefit. If your client has a life expectancy of 6 or maybe 12 months or less, they can get to a good portion of the death benefit. That's pretty universal. But these companies allow acceleration for chronic illness, which you might know as long-term care. They can't call it that due to the tax code it's filed under, but if your client has lost 2 of 6 activities of daily living, or they have severe cognitive impairment such as Alzheimer's, they can qualify for a portion of that death benefit to be accelerated to them while they're still living. And the critical illness portion, that varies a little bit from company to company, but it basically covers cancer, heart attack, stroke, end-stage renal failure, and several other items. Some companies cover 6 different critical illnesses. Others cover up to 20. Each company has their own specific list. But basically, if your client's diagnosed with one of those items, they can apply to the insurance company and have their death benefit accelerated. The company will make them an offer based on their health or lack thereof. The worse health your client is in, the more money they're going to be offered. If they're in great or relatively good health, they won't be offered as much, and there's a chance they might be offered nothing. But for a person who's facing tremendous medical expenses, this could be a source of funds to help them pay those bills that are not covered by their current health insurance policy. So again, those 5 companies have critical and chronic illness built in on the term policies outside of California. All right. The third item I want to cover is one company and one product in particular that has what I would refer to as a unique coverage continuation provision. And it's really hard to explain unless you look at an illustration. So what we're looking at here is a product from Protective Life. It's their Custom Choice UL. And I know it's a UL, and we're looking at a term comparison, and they market it as term. It shows up on the term comparison, but it's officially filed with all the states as a universal life contract. So if you're looking at the comparison, you'll see Protective up top. This is the classic choice term. This is not the Custom Choice UL. This is their low-price, true term product. You need to scroll down just a little bit more, and you will find the Custom Choice UL. Again, if the lowest price was $31 a month for this gentleman, the Custom Choice UL is only $3 or $4 more. In many cases, we've seen clients go for this product because of this unique feature. They will definitely pay a few dollars extra per month for this. So I pre-made a full illustration here that you can see. Let me get in the right scale so that it all appears on the screen. So this client, again, our same 45-year-old, $500,000, preferred non-smoker. I ran this one annually. He's paying $716 a year. And it shows what you usually would see if you did a term illustration. He pays the same $716 every year for 20 years. He has $500,000 of coverage. Now, it's what happens in year 21 that is interesting. With a normal term policy, the person gets to year 21, or hopefully beforehand they take a look at this. They probably have an option to convert this to something permanent, which they still do here. They can exchange this for another policy. But, same $500,000 converted to something permanent is going to cost a lot more. They could convert less than the full $500,000. That's fine. It's still going to cost more than what they've been paying. They could just let it disappear, and now they have no coverage. Or what some people do, and usually because nobody reviewed their policy with them, it rolls into what they call annually renewable term. The company just assumes that you're going to want to continue your coverage, but your premium is no longer level. Now you're going to pay the rates based on your actual age. And for this gentleman, that would be at age 66. Now, we don't see what those rates are in this case, but they usually end up being a good 10 times what the person has been paying. They're high enough that almost nobody pays those unless they're terminal or in pretty bad health. So what Protective has done with this product is something a little different. The default setting is not to have the face amount stay the same and your premiums go up every year. The default setting is to have your premiums stay exactly the same, and now your death benefit matches the cost of insurance charges that you were paying in based on that given age. So for this gentleman at age 66, his $716 buys $159,000 of coverage. Then next year it buys a little bit less. Why? Because he's a year older. Cost of insurance costs a little bit more. Age 68, again, it drops just a little bit. On every one of these, that first drop is going to be pretty big. It's going to drop by at least 40%. But after that, the decrease is gradual. So this ends up almost being like a built-in conversion option, or I don't know, a built-in permanent plan. I mean, it is a permanent plan. It's on a UL chassis. And eventually it will sort of morph into a final expense burial plan as that face amount continues to decrease. So many people, their needs change over time. If the house is paid off and the income replacement need is not as great as what it was, they don't need as much coverage. But look, they've already budgeted for the $700. They've been paying it for 20 years now. They're used to paying that bill. It would be very easy for them to continue on with coverage. Now, I mentioned the coverage goes down a little bit, eventually becomes a sort of a burial plan, and that typically happens around age 90. At that point in time, the policy will not decrease below $10,000. Because of that, though, the premium has to go up. So that's the only time when the premium starts increasing a little bit, assuming the client has made it that far. Another application for this might be to cover a mortgage, too. Now, you have to do a little trial and error, and I do have a video on our YouTube channel describing this. But you might say someone has a 30-year mortgage. You might set a little bit higher face amount, something that's above their current mortgage, run a 15-year custom choice, and then watch it decrease. And at some point in time, you should be able to match it up if you have their amortization schedule to that decrease in mortgage balance over time. Again, that's a little outside the scope of today's webinar, but I do have a video on our YouTube channel you can watch to see that. All right, so that was the third item. The fourth item I wanted to cover would be a premium decrease. Now, who wouldn't want to have their premiums decrease on their life insurance policy? So I'm going to change our quote that we see on the screen here a little bit. I'm going to run $1 million to get one other company to show up here. And this is, by the way, how easy it is to add a face amount on this quoting engine. You don't have to go back all the way to the initial input screen. You can stay right here. And we do have to scroll down to find it. Okay, so for this gentleman, $1 million of coverage, still 20-year term, we're looking at about $100 a month. The company I'm looking for is not showing up. And I know exactly why. Here's another quirk with this quoting engine. If you do want to change something on that second screen, it will only display the companies that were displayed on your initial quote. And John Hancock does not offer coverage currently at the other face amount. I've had to rerun the quote. All right, so here it is at the top. And by the way, they're about ready to decrease their maximum face amount to, their minimum face amount to $250,000. So you're going to see John Hancock show up a lot more. So you'll see the Vitality term product coming up the top of the list. A decent amount below all the other companies. Well, maybe, right? So the premiums will change. This is their Vitality term. And what that means is that it has this extra benefit on the policy called Vitality. And Vitality is a wellness and rewards program. Some people might have something like this on their health insurance policy, where if they exercise or get in a certain number of steps per day, they can save money or earn some extra rewards and prizes. And that's exactly what this does, right? If you hit the right levels, you can get a free Amazon Prime membership. You can purchase an Apple Watch for as little as $25. You can save all sorts of money on healthy foods at the grocery store. You can get discounts at REI and I think for some cruise lines and some hotels. And you can win all sorts of rewards with little online games that they have. But it's all based on keeping yourself healthy, eating right, and exercising on a regular basis. If your clients do not want to engage with Vitality and the app on their phone, this is probably not for them. However, if you have clients that are doing this already, why not help them save a little bit of money on their life insurance? So I mentioned their interaction with Vitality will determine what their price is. It could go down, it could go up. This page in the full illustration gives you a little idea of what might happen. What you see in the quoting engine is quoting their gold level premium. And if they achieve gold status every year, that's exactly what their premium is going to be. If they put in a little extra effort, their premiums could go down by 0.5%. So not a whole lot, but if they don't engage or don't engage as much, premiums might increase. 1.7% they show here. If they do absolutely nothing, no engagement at all with Vitality, they might actually be exercising, but they're not logging it anywhere. Premiums would increase by almost 2.5% per year. So you have to be careful quoting that. Make sure your clients know that this is not going to be a level premium. It could change. Now, of course, the higher the premium you start with, the greater the differences will be. But in this example, you can see we quoted $1,179. By the 20th year, your client might be paying $100 less per year. If they don't engage, they could be paying $700 more per year. Again, the only way to see exactly what that is to run a full illustration. This was done in the WinFlex web software. We actually have a link to that on our website. It requires a separate registration from our financial brokerage site, which you are certainly welcome to do, and opens up several possibilities for you. But in this premium schedule, you can see each and every year what those premiums would be if the client achieved that particular level. Again, $1,179 all the way through if they hit gold. But by year 10, they're saving maybe $50 a year at platinum, and of course $100 by year 20. So that's a product that could give your clients a decreasing premium. And not every agent out there knows about that. They're not going to be explaining it to your clients. You could be the one that brings that to the table for them. All right, the fifth item I wanted to cover in this quote comparison engine would be conversions. sometimes your clients know that they're going to need life insurance for a long period of time and beyond what you're quoting them for the level term period. But they can't afford those premiums today. At some point in time, they think they will, or maybe they're going to wait until later to get some sort of a permanent plan. Well, how do you know how long they have to convert the policy that you're selling them, or what's available to convert to? So I can tell you almost all of our companies allow conversions for the entire level term period. That means if you have a 20-year term, you can convert for those whole 20 years. One little caveat, though, that they have a maximum conversion age also attached. So if you hit that or exceed that maximum age, you're still within the 20 years. You could no longer convert. The maximum ages vary. They could be 65. 70 is probably the most common, and a few companies allow conversions all the way through age 75. Now, how do you know who allows conversions to what? I have a cheat sheet at my desk, happy to share that with you, or you can get to that yourself. All you have to do is click on the product name in the quoting engine here. And for this example with Banner Life, it gives you more details beyond the conversions, but here it says a convertible up to age 70. Or for anybody over 66, you can convert for the first 5 policy years. It also tells you the underwriting requirements for this particular person. So you won't see this with every single company out there, but most of them give you the conversion information just by clicking on the product name. So that's an easy little trick there. Lincoln Financial, their conversions options are a little bit more complicated than some of the others. So if you want to compare who does what, that's available to you. All right, moving on to the bonus idea, because I've gone through the 5 elements to take you beyond the price. I had mentioned that there's a way to hack the system, so to speak. If you have a client who is around 70 years old, and I'm going to input that right here. And in this case, we're going to look at a female, age 70. You've had a discussion with this client, and she decided that, you know what, nobody in her family made it past age 85. She thinks she can make it a little bit longer, but, going past 90 just isn't something that she thinks is going to happen. So she's only interested in a 20-year term. Let's run a 20-year term and see what it looks like. All right, we have pricing, in this case, around $2,900 a year. If that's all you did was run the numbers for what your client was asking for, you'd see these options, and that would be what she would be looking at. Take your pick of 3 or 4 companies, all just under $3,000. Now, here's a way to what I would call hacking the system. Let's flip over to a GUL. We can do this on the same quoting engine. Since our client was 70, a 20-year term takes her exactly to age 90. One of our options for quoting a GUL is to quote it to guarantee to age 90. So we're going to do that and see where the pricing comes out. Oh, look at this. She could still pay about $2,900 or $3,000 if she wanted to, but now we have a company showing up at under $2,500. Just one in this case. I ran a quote similar to this earlier for a male at a little higher face amount, and I think we had 2 companies that were coming in below the lowest priced 20-year term rate out there. I can tell you this won't work every single time. It will be different depending on the rate class and the age, but if they're right around age 70, give or take a few years, you can usually make this work. You're looking at about the same price, and in many cases a lower price if they apply for a GUL rather than the term that they were initially asking for. So that's a little way to hack that system, as I would like to call it. So, and that's really the conclusion of today's webinar. I'll get to questions here in a second, but I do want to put in a plug for the next webinar in the basic training series. This will happen 2 weeks from today, and we're going to be reviewing our allocation tool, our life insurance allocation tool. You may have heard of asset allocation if you deal with securities. Well, this is going to be something similar, but dealing with life insurance. So we actually have a quiz on our website for your clients. You could certainly input their answers, and it's going to tell you how much coverage they need. It's also going to tell you how much of that should be term, how much of that should be permanent, and if there is some permanent in the mix, what kind of permanent coverage should that be? And by doing this, you're going to have your client's own answers. It's not going to be you presenting it to them. It's their own idea from the get-go, and this certainly leads to a little higher dollar sales by introducing that permanent coverage in the mix for them.